Welcome, everyone, to Joseph Markets, your go-to source for insightful finance discussions powered by cutting-edge analysis. Today, we're diving into a topic that's reshaped the entire cryptocurrency landscape: how the BlackRock Bitcoin ETF changed the market. If you've ever wondered how one financial product could spark billions in investments, skyrocket prices, and bring Wall Street giants into the crypto world, you're in the right place. But before we jump in, if you want more 100% verified news and spot-on advice like this, hit that like button, subscribe to Joseph Markets, and drop a comment below saying Joseph Markets to stay updated. Your engagement helps us deliver the truth straight to you. This video key points on how the BlackRock Bitcoin ETF changed the market. Research suggests that the launch of BlackRock's iShares Bitcoin Trust, IBIT, in January 2024 marked a pivotal shift, making Bitcoin more accessible to mainstream investors and driving significant institutional adoption. It seems likely that this ETF contributed to Bitcoin's price surges, with peaks reaching $126,000 in October 2025, though recent volatility has brought it down to around $66,000 as of February 2026. The evidence leans toward increased market liquidity and maturity, but ongoing drawdowns highlight persistent risks. While some views emphasize transformative benefits like easier exposure without direct custody, others note challenges such as heightened speculation and regulatory scrutiny, reflecting a balanced perspective on its impacts. Overview of the ETF's launch and role. BlackRock's IBIT provided a familiar regulated vehicle for Bitcoin exposure, similar to traditional stock ETFs, eliminating barriers like crypto wallet management. This opened doors for retail and institutional investors alike. Market impacts. Price dynamics. Post-launch inflows correlated with Bitcoin's rally from around $40,000 to highs over $100,000, though corrections followed due to factors like Federal Reserve policies. Institutional inflows. Assets under management grew to over $70 billion at peak, now at about $50 billion, attracting entities like Harvard and sovereign funds. Broader adoption. It accelerated Bitcoin's integration into portfolios, with institutions allocating 1% to 2% on average, fostering ecosystem growth. For more details, see sources like BlackRock's Insights and iShares Overview. Potential drawbacks and controversies. Critics argue it amplified volatility through leveraged trading, while proponents see it as a step towards stabilizing Bitcoin as digital gold. This duality underscores the need for cautious optimism in crypto investing. Now let's start with a hook that might just blow your mind. Picture this. In early 2024, Bitcoin was hovering around $40,000, still seen by many as a risky, niche asset for tech enthusiasts. Fast forward just 2 years, and thanks to one powerhouse move by BlackRock, the world's largest asset manager, Bitcoin hit an all-time high of $126,000 in October 2025. But that's not all. This single ETF has pulled in over $70 billion in assets at its peak, turning crypto from a speculative gamble into a staple in institutional portfolios. Stick around because by the end of this video, you'll understand exactly how this happened, why it matters for your investments, and what it means for the future of finance. We'll break it down step by step, with real data and citations to back it up, so you can trust every word. First, let's set the stage by understanding what a Bitcoin ETF even is, and why BlackRock's entry was such a game changer. A Bitcoin exchange-traded fund, or ETF, is essentially a financial product that tracks the price of Bitcoin without you having to buy and hold the actual cryptocurrency. It's traded on traditional stock exchanges like the NASDAQ, just like shares of Apple or Google. Before ETFs like BlackRock's iShares Bitcoin Trust, ticker symbol IBIT, came along, investing in Bitcoin meant dealing with crypto exchanges, managing digital wallets, worrying about hacks, and navigating a maze of regulations. It was cumbersome, especially for big institutions like pension funds or hedge funds that prefer regulated, familiar vehicles. According to BlackRock's own market insights on their website, the iShares Bitcoin ETF, IBIT, transforms Bitcoin investing by offering access through traditional brokerage accounts, trading like a stock, and integrating seamlessly into taxable or tax-advantaged portfolios. This convenience addresses key obstacles: no need for new accounts on crypto platforms, no high trading fees, and reduced security risks since the ETF handles custody through trusted partners like Coinbase Prime. In essence, IBIT democratized Bitcoin, making it as easy to buy as any other ETF. But how did this change the market? Let's explore point by point. Point 1. The launch of IBIT marked a seismic shift in accessibility for investors. Prior to January 2024, Bitcoin exposure was limited to direct purchases or futures-based ETFs, which came with premiums, roll costs, and less direct correlation to Bitcoin's spot price. BlackRock, managing over $12.5 trillion in assets as of mid-2025 according to their filings, brought credibility and scale. When the U.S. Securities and Exchange Commission (SEC) approved 11 spot Bitcoin ETFs on January 10, 2024, including IBIT, it was a watershed moment. Trading began on January 11th, and IBIT quickly became the leader. To illustrate, consider the rapid asset growth. As per data from SoSo and BlackRock's reports, IBIT amassed over $69.7 billion in assets by late 2025, making it the fastest-growing ETF in history. Even as of February 18, 2026, amid market corrections, it holds $50.37 billion in net assets, representing about 1.34 billion shares outstanding. This isn't just numbers, it's evidence of how IBIT lowered barriers. Retail investors could now add Bitcoin to their 401ks or IRAs without tech hurdles, while institutions gained a compliant way to allocate. According to a CNBC report from January 2026, this has led to a predicted major shift in retail access to cryptocurrencies, with BlackRock's Jay Jacobs noting that ETFs are still a fairly new concept, but poised for growth among Main Street investors. But wait, here's a retention hook to keep you watching. What if I told you this accessibility didn't just boost participation, it directly fueled Bitcoin's price explosion? We'll get to the exact price impacts in a moment. But first, let's talk about the regulatory and ecosystem changes that made this possible. Point 2. 3 major shifts enabled this transformation, as outlined in iShares, BlackRock's ETF arm, analysis on their website. First, global forces accelerated investor interest. In the post-COVID era, rising inflation, geopolitical tensions like ongoing conflicts in Europe and the Middle East, and banking crises, think the 2023 regional bank failures, made Bitcoin appealing as a digital gold or hedge against fiat currency devaluation. Bitcoin's fixed supply of 21 million coins contrasts with endless money printing, drawing in investors seeking alternatives. According to BlackRock, these factors, combined with demographic shifts like younger generations living virtual lives, have driven Bitcoin's adoption faster than the internet or mobile phones, reaching 300 million users quicker per Bloomberg and Cambridge Center data. Second, the development of ecosystem infrastructure. Significant investments in crypto tech have improved trading, custody, and transparency. Institutions now have robust tools, like Coinbase's institutional-grade custody, which BlackRock integrates. This maturation turned Bitcoin from a volatile experiment into a viable asset class. Third, regulatory evolution. Policymakers worldwide adapted frameworks to oversee digital assets while fostering growth. The SEC's 2024 approvals were a culmination of years of scrutiny, ensuring investor protections without stifling innovation. As BlackRock notes, this created the conditions for mainstream ETPs, exchange-traded products, like IBIT. These shifts didn't happen in a vacuum. They directly paved the way for BlackRock's ETF to change the market. Now let's hook you further. Imagine Bitcoin's price doubling in months post-launch. Was it coincidence or causation? Stay tuned as we unpack the immediate market reactions. Point 3. The immediate price impact following IBIT's approval was dramatic. Bitcoin was trading around $46,000 just before the January 2024 approvals. Post-launch, it surged, hitting $69,000 by March 2024 and eventually peaking at $126,000 in October 2025, according to Bloomberg data cited in BlackRock's Volatility Insights. This rally was fueled by massive inflows. IBIT alone saw billions pour in weekly, creating buying pressure that lifted Bitcoin's market cap to over $2 trillion at its height. But why such a boost? ETFs like IBIT provide indirect demand for Bitcoin as the fund buys actual BTC to back shares, with IBIT holding over 786,300 BTC at one point, per trading key data from February 2026. This locked up supply while demand soared. A Forbes article from November 2025 highlights how BlackRock's update helped Bitcoin bounce from $80,000 lows, with experts calling it a massive integration into U.S. financial infrastructure. According to Jonathan Yark of Acheron Trading, Bitcoin became a strategic position rather than a speculative trade. However, the ride wasn't smooth. Volatility persisted. BlackRock's December 2025 insight on crypto volatility identifies four key factors behind recent dips: shifts in Fed rate cut expectations, higher real yields pressure risk assets like Bitcoin, unwinding of excessive leverage in futures markets, leading to flash crashes, whales, large holders, rebalancing at psychological milestones like $100,000, and fading optimism around digital asset treasuries. Since IBIT's launch, Bitcoin experienced two 25% plus drawdowns before the latest from $126,000 to $84,000, a 33% drop, each followed by recoveries to new highs, per BlackRock calculations as of November 30th, 2025. This volatility underscores a key change. The market became more resilient. Pre-ETF crashes often led to prolonged bears. Post-IBIT, institutional inflows provided a floor. For instance, despite a 45% price drop from all-time highs by February 2026, Bitcoin at $66,000 per CNBC and CoinDesk reports. Spot ETFs still hold $85 billion in assets, equating to 6% of Bitcoin's supply. Let's pause for a retention strategy. If you're thinking, this sounds great, but how has it affected real institutions? Coming up, we'll look at specific examples of adoption that prove IBIT's market-altering power. Don't forget to like and subscribe to Joseph Markets for more. Your support ensures we keep bringing verified insights. Point 4. Institutional adoption skyrocketed post-IBIT launch, fundamentally altering the market's composition. Before 2024, institutions dabbled via futures or private funds. ETFs changed that. BlackRock itself views Bitcoin as a portfolio diversifier, recommending 1–2% allocations for those with risk tolerance, per their institutional insights. Real-world examples abound. Harvard Management Company, as reported in Yahoo Finance and P&I Online in February 2026, shifted crypto exposure, trimming IBIT holdings but maintaining significant positions valued at $266 million, down from $442 million. This shows endowments treating Bitcoin as a long-term asset despite volatility. Sovereign funds jumped in too. Abu Dhabi-based Mubadala and Al Warda held over $1 billion in IBIT shares by end 2025, per the Block and Bitcoin.com filings. 20 million plus shares worth $1.039 billion then, now $803 million amid price dips. This signals Middle Eastern wealth diversifying into crypto. European banks followed. Italy's Intesa Sanpaolo disclosed $96 million in spot Bitcoin ETFs, including IBIT, per Yahoo Finance, plus options on MicroStrategy. This conservative sector's entry validates crypto's legitimacy. Even Chinese-linked capital surfaced, with Hong Kong's L'Aurora Limited holding $436 million in IBIT per AMB crypto despite restrictions, highlighting global shifts. According to Datos Insight's July 2025 report, U.S. regulatory clarity unlocked $3 trillion in potential institutional capital, with IBIT as the gateway. By Q4 2024, institutions held $27.4 billion in Bitcoin ETFs, doubling prior quarters, with hedge funds at 25% market share per AltRady. This adoption deepened liquidity. Daily IBIT volumes hit 85 million shares, per BlackRock data, reducing spreads and stabilizing prices. It also matured the market. Bitcoin now behaves more like equities during macro events, correlating with Fed policies. But here's a hook to keep you engaged. With all this growth, what about income generation? BlackRock didn't stop at spot ETFs. they've innovated further, potentially changing how we earn from Bitcoin. We'll cover that next. Point 5. BlackRock's expansions post-IBIT have amplified market changes. In January 2026, they filed for the iShares Bitcoin Premium Income ETF, an actively managed fund using covered calls on IBIT to generate yield, per CoinDesk and investing.com. This targets income-focused investors, bridging traditional finance and crypto. It tracks Bitcoin while selling options for premiums, offering payouts even in flat or down markets, though with risks like volatility impacting share values. BlackRock also entered DeFi, listing their tokenized treasury fund on Uniswap in February 2026, per TradingView and Cointelegraph. This allows institutional token trading, accelerating crypto's mainstream push despite sliding valuations. These moves made BlackRock's crypto products their top revenue driver, with IBIT outperforming legacy funds, per Nasdaq's December 2025 report. IBIT's success, fastest to $70 billion AUM, reflects investor behavior shifts toward regulated crypto exposure. Point 6. Long-term market transformations include reclassification of Bitcoin. Banks like Wells Fargo now view it as Tier 1 collateral, per TradingKey's February 2026 analysis. This enables credit facilities integrating Bitcoin into traditional banking. Capital rotation emerged. While Bitcoin ETFs saw inflows, Ether ETFs faced outflows, with funds shifting to Solana and XRP for higher returns, per the same report. Bitcoin remains the digital gold anchor. However, challenges persist. Recent outflows, $105 million on a single day in February 2026 per AI Invest, led by IBIT's $119.8 million, tie to Fed hawkishness and liquidity concerns. Year to date, IBIT's return is 22.68%, lagging peers, but net inflows over a year remain $21 billion for IBIT and $14.2 billion category-wide, per CNBC. This suggests trimming by speculators, not abandonment by long-term holders. Analysts note 75% of IBIT is held by market makers and hedged funds, per CoinDesk, masking true bullish exposure. Still, resilience amid a 50% price crash from peaks shows matured market depth. For a retention boost, as we near the end, consider this. Could IBIT pave the way for Bitcoin at $1 million? Experts think so. We'll explore forecasts next. Point 7. Future outlook post-IBIT is optimistic yet cautious. Wall Street predictions vary. ARK Invest's David Puel sees $710,000 by 2030. Alliance Bernstein's Gautam Chugani targets $1 million by 2033. Fundstrat's Tom Lee predicts $3 million long-term. MicroStrategy's Michael Saylor envisions a $200 trillion asset by 2045, implying 9,400% upside, per Nasdaq's October 2025 article. BlackRock believes long-term drivers, institutional adoption, regulatory maturation, debt concerns, remain intact, with 2026 paths tied to rate cuts and advisory uptake. In summary, BlackRock's Bitcoin ETF didn't just change the market, it redefined it, from accessibility and adoption to volatility management and innovation. If this resonated, subscribe to Joseph Markets, and comment Joseph Markets for more true finance insights. Thank you for watching. Stay invested wisely.